All right. Hey, welcome everyone to the state of fraud and AML. We're looking at three trends impacting banks here. I have a great panel along to join with me. A few folks that I've worked with in the past and a few new faces. Want to first of all, give a shout out to the American Banker for sponsoring this. So appreciate our partnership there. So let's just jump into it. It's pretty straightforward. So quick intro of me. I'm Alistair. I'm the Chief Operating Officer at Unit 21. I'll do the obligatory commercial at the end, but we're an AML and fraud platform. We work with a lot of banks, credit unions, and fintechs in the industry. This is a live recording, so excited to have our team here. I have some questions that hopefully that they haven't seen yet, and they can answer live. We also have a Q&A, so feel free to ask your questions in the chat. We'll try to address them as we see them, though multitasking is not my skill, but we'll try to also async the questions that we didn't get to. So, but let's start. First of all, maybe I'll just go left to right. Katie, so I got some questions for you. So one is, if you don't mind, introducing yourself. Where are you? What's your role? What's the industry you work in? Where are you located? And if you could compare the world of payments and fraud prevention to a movie or TV show, which one would it be? And I got one at the end. So, like, I know I'm putting you on first, and then Kyle and Donna can think
Oh,
about
they
that.
get time to think about their answer. No fair.
No,
Uh,
exactly. Sorry about that. Kick it off.
Hi, everybody. I'm Katie Robinson. I am here, well, honestly, representing myself, the obligatory little legal landscape notice. But my background is in investigations. I'm a certified fraud examiner, a certified anti-money laundering specialist, and a GRC professional. I've been worked for the FBI for 4.5 years as a forensic accountant, then worked as a regulator overseeing financial institutions in the state of Washington, which is where I am now. And now I actually work for a few of those financial institutions, helping gear up second line functions, specifically specializing in enterprise risk management and fraud risk management. I am also the president of the ACFE chapter up here in the Pacific Northwest. So I am super excited to be able to not only share my insights when it comes to banking and fraud prevention and anti-fraud measures. I'm really excited to see kind of the survey responses that you got. But I know also that our local AC and CFEs are extremely excited about this education. So thank you for hosting.
Cool. Appreciate it. Thanks, Katie. Donna,
And
you're up.
to answer your question,
Oh,
sorry,
sorry. I was
yes,
gonna come back
to
to you.
compare to a movie. Oh my gosh. I'm going to have to go with being able to compare payments versus, payments versus fraud. Oh man. The only movie that's coming to mind right now is The Sandlot. I don't know why, but it's just a jumbled chaos mess, but you always learn something. It's like you're always learning something from the payment space, and you're always learning something from people that do and take advantage of these channels, and it's a cat and mouse game. So we keep on learning from each other and how to make it better and how to make it more secure for customers all around the globe.
I like it. Maybe like the guy that you thought was a bad guy was actually a good guy. That's always like
Yes,
the
it's
beginning.
always the "you're killing me" smalls. Like it's just, yeah.
Killing me. All right, Donna, you're up.
Hey, Ian. Thanks for having me. I'm Donna Turner. Just quick background. Retired banking. Spent 30-ish years in banking. Typical bank background, right? Operations, risk management, product. But I had the opportunity to spend the final 10 years of my career at Bank of America, helping to build out and then ultimately lead our enterprise fraud organization. Retired from banking, and from there decided to go work at the industry level. So took a role with early warning services just prior to the launch of Zelle, which kind of became their chief operations officer to get Zelle up and running, kind of get it industrial strength, sustainable, all the operational processes and disciplines that we needed around running a network. So um, am attempting to be semi-retired now. I currently serve as an advisor in residence for EY. So really just gives me an opportunity to kind of parachute in on different client topics, weigh in, kind of add that experience and insights as those clients are figuring out solutions and path forward. Um, I have to tell you, I have what my friends would tell you is an incredibly notable lack of depth on movies and TV shows. I think it comes with the attention span of a 2-year-old, which works really great in fraud risk management, but doesn't mean that I can get through movies and TV shows. So I'm going to go with like one of the few I watch, which is CSI. Insert any other ones you like, because I think fraud risk management is ultimately like who's beating you and how are you getting beat and solving for that hour in and hour out. So when I think about CSI and the hey, who did the crime and how did they do it, or maybe that's vice versa, you get the idea. That's the best I got. And I've never seen Sandlot, so I've got nothing.
That's
I
right.
told you it's limited, Katie. I told you it's limited.
You're killing me, Smalls.
By the way, Donna also is proprietor of a brewery too, so in the Charlotte area, which I've had many beers at. So I just want to let like that from my point of view, that gives you a pass on the movies. All right, Kyle, you're up.
Thanks, Ian. Thanks for having me. Kyle Daddio. I'm a managing director at Stout, where I lead our regulatory compliance and financial crimes practice. Been in the industry for several years. Started my career similar to Katie at the FBI in the counterterrorism division. Based out of Chicago now. Been in the consulting side for several years. Did a stint at an international financial firm as the chief AML officer, post-enforcement action. So kind of been through the weeds of building out a program from scratch and rebuilding and kind of fixing a program. Done a couple of these with you guys at Unit 21. Really enjoy working with you all and really interested to see the insights that come out of this. Again, I know there's a lot of stuff that's going to come up that we haven't necessarily seen. So a lot of reaction on this, which I think will be really exciting. As far as movies and TV shows, I don't know that the movie itself really ties into it, but the name Mission Impossible keeps popping up in my head of trying to get to stopping fraud in payments. And then the other thing that pops up is Seinfeld, because I feel like it's kind of just a group of comedy of errors of there's all these different characters and activities going on and trying to wrangle around what's going to happen next and where it's going to go. I feel like there's a lot of Kramers and Georges out there that are we're trying to keep up with. That's just really difficult. So those are the two things that pop up for me.
I like it. Mine is Little Mermaid. I'm a product of the 80s. And I mean, Ursula, the sea witch, she stole the identity of Ariel. So, I mean, like there's identity theft. I just feel like that popped in mind. So and it's the OG Little Mermaid, not the latest one. So anyway. All right, let's jump into it. Cool. So we surveyed about 500 people across the industry, and that spanned banks, credit unions, and fintechs. And so we've actually been able to cut this data a bunch of different ways across industries, which is pretty cool. And we're actually releasing that, like the full results later this month at Money 2020. But so this one specifically, today we're going to look at some data that is across the respondents of about 100 commercial banks. You can see the job function, the seniority of the people, and also the asset size. So a couple of things I just call out from a job function standpoint. About half are AML focused, although today is mostly we're gonna cut on the fraud side. But you can still see between fraud and then the fraud, like the fraud AML, almost 50% there. From a seniority standpoint, it's about a third are analysts. People are working kind of alerts, working the actual fraud cases themselves. And then you have like the middle management, which I would say is like an SVP, VP type of level at a bank. And then the executives. So that would be like EVP plus, so C-suite. We have some in there. And then just from an asset size, it's a pretty relative, it's a general distribution across kind of what you probably see in the US anyway. A lot of smaller community banks are responding. Maybe the more state-sized banks in the 2 to say 50 billion. 50 billion is probably more multi-state, and then the greater than 50 would be super regionals and the largest enterprise banks. But just a good distribution, and you're going to see. And we actually have a couple of cuts on the asset size too, which will help. All right. So first of all, we're going to talk about scams. We're going to talk about kind of three main topics. The first one's going to be scams. It's, topic du jour. Um, and, the respondents more or less said like, scams are up. And I don't think that that's a novel statement. I think we've had our own scams webinars specific here at Unit 21. But it's up, and it's also up pretty massively between 25 and 75%. And then, the specific types of scams. So it's mostly phishing and romance scams, and that's about close to 50% represent those as the top scam types. And so I guess, Katie, I'll just start with you. Generally, does this gel with what you're seeing in your network, like who you talk with and kind of what you're seeing?
Yeah, and the thought that comes to my mind is that this increase could be a result of the scam tool that came out earlier in the last 12 months from the Fed, where being able to identify and call something out as a scam is becoming a little easier now that people have a more clear definition. So I'm wondering if also there's a data component as well. But people are still susceptible. It's never going to go away. So yeah, I think this is absolutely normal. I think people are getting more comfortable also with reporting things to the bank.
How about Kyle, Don? I'll throw it to you guys too around the people, the client base you guys work with. Are you seeing the same thing, Kyle?
Yeah, I think the difference too that I'm seeing between the phishing and the romance scams, I think what we're seeing with some of our clients and the people we're talking with is that the romance scams are occurring a lot more often and are being reported a lot more frequently at some of the smaller institutions. You're talking 8 to 10 billion and below. I feel like we're seeing a lot more from that size, and the phishing scams are coming and being more targeted at some of the larger institutions. And so I think a lot of that, and we'll dig into it a little more as we go through this, but I think to what Katie was saying, there's a lot more focus on reporting. I think some of the regulators have stepped up their focus on the 50 billion, 25 billion and below banks. And so you have this engagement with the regulators now where a lot of these banks may not have recognized where scams were occurring or how frequently they were occurring, and may not have been as comfortable with reporting it. And so we're seeing it a lot more because of that. But I think the romance scams at some of the smaller regional banks and institutions, I personally have had a lot more conversations about over the last few years.
And Don, a lot of your network is like, I don't know, maybe it's evolved since you've been at UI, but like, more of the more enterprise organizations. Does that gel with you, like kind of what you're hearing too?
Yeah, I think a couple things. I mean, I think it's a fair point about the reporting, but this isn't new, right? I always remind people about your Nigerian uncle.
Mm-hmm.
There's nothing new here. Yeah, the taxonomy, the awareness helped. What I would point out about the growth rate is it's going to go up. As the other geographies around the globe are getting more and more organized around this, we're going to squeeze the balloon, and we're going to see the attack rates in North America just continue to escalate because, and again, I put our Canadian friends in the same boat here. We do not have this centrally organized approach, whether it's private sector or public sector, around getting organized around scam, around getting organized around fraud, because they've already seen in the UK, right, the switch back to payment cards from APP. Again, they're going to find a way to get their money. So I would tell you on the growth rate, 100%. I would also give you a prediction that we're actually going to continue to see the attack levels and the impact of scams continue to grow here in the years to come until we are able in North America to get organized around this. What jumped out at me about the phishing and romance scams was that investment scams weren't on there. And again, Ian, to your question, might be kind of whose sandbox I spend more time in. If you look at this on a dollar basis, here domestically and globally, investment scams are actually the tall bar. Fake websites, fake solicitations. I mean, incredibly proficient, incredibly professional looking. And again, we are not organized here in the US for the rapid identification and takedown of these sites. There's some work going on with the SEC to hopefully influence that and get something going here in the States domestically. But that's what jumped out at me is I really expected to see investment scams as the tall bar.
Huh, interesting.
And to add on to that, the part that I see that strikes me on phishing versus romance scams is the social engineering aspect. To go to your point about investment, this is classic human manipulation. And not only that, but we're having these bookended generations that are becoming more and more susceptible. So it's we have our older generations and our younger generations who are not able to discern whether or not they're being phished or taken advantage of.
Yeah, it's funny. So I had a family reunion, total non sequitur, but we have a full thread for text together with, spans people that are in their 90s down to like when they're 12, and I sent them pig butchering type of articles, and the John Oliver pig butchering video, and I think it's good. Like, one is just like education. You got to start somewhere, especially with that. But I appreciate like you're talking about like the bookends. All right, let's jump in a little bit more details. So this is a cut between larger banks on the left and smaller banks on the right. And it talks about what percent reimburse, and then also kind of what their annual losses are. Now, I'll go to the annual losses first. Like, that actually kind of makes sense. Like, if you're a larger bank, you're going to have probably larger losses, smaller banks, smaller losses. But the reimbursement thing is pretty interesting. All right, Donna, this is one where I'm coming at you. So are big banks bad because they don't reimburse as much? I mean, you and I worked at a consortium of big banks. And by the way, I still very much, I think the focus there is to ensure that, you're protecting the consumer. I know that that's number one at the heart, but like, this doesn't demonstrate that, right? So what's your thought?
Well, or does it? Big brands, right? So if I'm a bad guy and these guys have a business to run, remember, this is organized crime. This is not some kid from the 70s dumpster diving, right? This is organized crime. So I'm going to attack the brands that have the greatest market share, because that's the most economically efficient way for them to affect what they do. So if I've created a fake OTP or an OTP interdict, and I can do that for Chase Bank, right? Then suddenly I open up tens of millions of potential targets, as opposed to if I go after Bob's Bank of Omaha, my probability of success, the economics of my pull through, are greatly diminished. So it's just the law of large numbers. It's the law of market share. So be careful there. I think the reimbursement, it kind of goes along the same lines, right? I think you see a pretty consistent effort around an application of reimbursement around imposter scams and what I simply call bad hygiene. So you purported to be the bank, you purported to be law enforcement, the IRS, utility company, something like that, where it was expressed that there were dire consequences if you didn't take action on this scam. Your money's going, your electricity's getting off, someone's coming with handcuffs, etc. So I think there's a general awareness and acceptance that if I go back in time to the early days of digital banking, phishing that created man-in-the-middle software or something, like, you did what you could. You did what you thought was the right thing. So, how do we make sure that you're made whole under that? I still talk like a banker. I still say we. And I think the losses kind of follow suit with that. So I don't think that they're more stingy. I think it's just the law of large numbers. You're going to see a broader set of scam vectors, your scenarios, etc. You're going to see a pretty consistent application around imposter, bad hygiene, etc., where they're going to apply that. And otherwise, it's just big numbers.
Makes sense. It's like a total addressable market from a fraud perspective. Go after the big guys. Mm-hmm. Katie, how about how do you think in your sphere people think about reimbursement versus not? Is it aligned with what Donna was just saying, or are there other variables?
I think that's totally fair, especially from the larger bank side. From a smaller bank side, this number actually doesn't surprise me that much. It's a more reflective, I think, of customer wanting to build customer loyalty, customer brand, and customer relationships, where there's more of a willingness to to have more of a retention and assistance to customers. So the want to be able to reimburse them, make them whole is greater. So that one kind of goes along pretty well. So I would say kind of both sides. We have the law of large numbers on the larger asset size, and then we have this customer loyalty need that we want to be able to make that customer whole and happy. So regardless of whether or not they can prove it out, they're going to do what they can to make sure that they have that customer retention.
Yeah, the brand reputation for smaller organizations too just have like such an impact when you have like these events. They just have like broader like splash areas. If like they don't do a reimbursement, then it creates this like ripple effect in a community too. Like when you hear that, no offense against the larger financial institutions, people when they don't get a reimbursement probably just kind of goes into the ether. You know, just people are like, yeah, it's a big bank. But to your point, Don, I think it's a fair one. Like, you know, maybe the 50% are all consumers that are like good people that they know, and the other 50% are the ones that they like have thoughtfully filtered out as like really bad actors. All right, Kyle, I'll get to you in 1 second. All right, so the next one is check fraud. Again, not a novel thing that it's evolving, but banks are, again, similar increase, which is like 30% of banks reporting a pretty large increase in check fraud over the last 12 months. And more specifically, you know, you can see that where the common attacks are, though some of these are probably a little bit of a Venn diagram where somebody steals a check and then they counterfeit it, they wash it, whatever. But I guess, Kyle, I guess my question to you is like, there's a lot of discussion around check fraud as late. I hosted a webinar a couple of months ago on check fraud. And this has been starting, you know, as with the COVID relief checks, PPE checks, all that kind of stuff. I think it's kind of like proliferated. But why does the trend continue from your perspective? Any thoughts?
Yeah, I think the PPP and some of that the government assistance checks certainly ramped up the opportunity to do it over the last few years. But part of it too, what we're seeing is it's what's old is new again, right? I mean, there's been so much advancement in technology to stop what's considered at the forefront that institutions can't necessarily or haven't been able to stay on top of everything. So as focuses shift, you have kind of what's left over on the back end, right? So if you look at and take the difference of how this is conducted, right? If I'm doing account takeover, if I'm doing phishing scams and things like that, I'm doing a lot of technology-based operations to get into networks, to get into systems, to gain that access. On the check fraud side, what you're typically dealing with, if I'm a bad actor, right? So I'm in Chicago. I've got my group that's performing these operations. We're going to branches to do this. You're potentially going to certain neighborhoods. You're going to areas where there may not be sufficient training and different things at the branch level where I can conduct and work this operation to a larger scale just by leveraging that opportunity, right? And the controls in place may not be the same. I think I personally over the last 2 years have done a lot of work with clients at kind of the regional bank level and kind of that 10 billion, 25 billion and under, working on training and working on staffing to make sure they understand what to look for when people are coming in, what kind of the red flags are, why these actors are acting certain ways, what the process is to do that. And I think a lot of it is the opportunity, right? If everybody, like I said at the beginning, if everybody's focusing on the online activity, if everybody's focusing on that type of fraud that's on the electronic side, the check fraud side can be left really vulnerable and available to operate.
Yeah. And Donna, I mean, this stuff is old, like Kyle said, what is old is new again. Are the controls new, or are they like, are banks having to figure out new controls, or are they just kind of like dusting off old COBOL code or something like that, just to get them back to protect themselves?
Yeah, I think you're seeing a lot of development and adoption using machine learning, using AI. Historically, a check fraud analyst, we would have looked at our own items coming through. There would have been some algorithms running in the background around, was it out a number sequence? Was it out a dollar amount, out a pattern there? An analyst would randomly click on prior items and kind of do a visual comparison. Well, modern technology says that all that can happen before it's presented to them. Some of these UIs literally circle what the analyst should be focused on, why it triggered as an anomaly. Would have seriously helped me because I would have been fired after one day as a check fraud analyst. So I think there's new technology that's absolutely helping here. It's not inexpensive technology. It takes a lot of horsepower to run that, but I think you're seeing it applied in two ways. The checks and also deposits, because remember, they're not going to take these checks and go to the FI that it's drawn on. They want to go to a different FI, which then opens that FI up to breach of warranty exposure. So not just thinking about your check clearing, but also thinking about your deposits and making sure that you're looking at this new technology. You're looking at whatever technology you use, whether it's your in-house technology or not, and you're thinking about your exposure on both sides of this is really important to do. So I think it's there. I think there's a lot of growing kind of collaborative approaches there where you're able to contribute your check stock. So it just gives them more and more signals to be more accurate in both detecting bad and not interrupting good. So I'd highly encourage folks, like if you're not out there actively knowing what's and seeing what's going on in the technology space for check fraud detection and deposit fraud detection, please do so.
Katie, thoughts on that?
I can't not agree with what both of them have said, and I really, when it comes to looking at checks, and to your point earlier, checks are not going to go away. They're still a very useful form of tender. They're going to be sticking around. It's very easy for people to understand and to use. So, and it's going to constantly be a payment system channel that we have to think about. So, the fact that we're kind of reverting back to a system of tender in a fraudster perspective that is basically very reliable, it's only going to get, I would say, amped up here in the future.
Yeah, that's what it feels like. Well, I'm going to do a little recycling. So there's a couple of things that we threw in here. So on the left are a couple of checks that we found on Telegram. And it's interesting because they're not only just pulling the checks, but they're also giving some economic value to these based on other data that they were able to pull through open banking, right? So like, if you look on the left, they're like, it's a $532 check. There's known availability on the account. They have the date of birth, they have full scan, they're saying it's worth 600. The other one, which has less availability on the account, so, potential that it will clear, is worth less. So like there's economics of like the value of these checks too, which is pretty interesting. In the middle, universal keys, which open up like, geographical areas, postal service mailboxes. Those are very expensive and also can be made through digital printers, which is pretty crazy. And then on the right is it's just more or less an innie, like an internal person who works at the USPS and says, hey, listen, I have access to all these things. And the video is very interesting because it highlights how much they take and then they bring it to like a drug house where it gets sorted, which is, it's kind of crazy. Another thing I'll just like call out is there was a guy, 29-year-old out of St. Louis, who was just indicted for $1.5 million stealing. Like face value of check fraud of 1.5 million. So and this just happened like in the last couple of weeks. So it's just an interesting recent case that came out. I assume there's a lot more out there. But I guess, Katie, which ones of these scare you the most, I guess? Is it Telegram? Is it people stealing checks? Is it,
I think in general, the system that allows the advertising of all of this is actually what bothers me the most. All three of these are really bad threats and they are absolutely control issues. But when it comes down to it, the fact that people have a forum to advertise and it's almost like a Craigslist version of fraud. It's just sickening.
Yeah. Well, what we're seeing also in the responses are just around how much organizations are losing, which I actually found, again, these are banks and it's across a distribution of like small and larger banks, but you can see like 63% said they lose less than 100, all the way up to above a million. I assume that's probably pretty correlated to the size of the organization. That's one. And then we also asked what are the we in the survey we asked about 10 different types of fraud, and this is the right chart, and which ones take the most time to work those alerts or work the fraud, and which ones are most costly. And account takeover came out as number one, and check fraud as number two. But maybe I'll just start actually, Don, I had a question for you. Do you think these loss rates, are these normalized? Are they just kind of banks are willing to take certain losses on check fraud? Or they continue, like you said, the tools can be expensive. The technology is evolving, but still maybe cost burdensome. Is this just okay, this is just a trend we're gonna have to continue to take? Or are they what, we actually have to double down on these tools, these check fraud? What are you seeing in the market?
I think you're seeing that shift. I think for many years, check fraud had become a bit of an acceptable loss because checks were going away, right? So why was I going to invest there? Losses were pretty steady. So you could say on a rate basis, yes, they were increasing, but that kind of beget the strategic question of, well, how much do we really want to invest here? Let's move on to the next topic. So, but that's shifting now. Now you're seeing the economics say, hey, we maybe there is an investment appetite here, but you still get into that runway question. For how long? What does that ROI look like? Does that ROI drop off even in a more accelerated manner, not just because of the effectiveness, but because of that denominator effect, or the volume of good checks that are out there in the ecosystem as well? So I think you're seeing it shift, and I think it's appropriate that you're seeing it shift.
Yeah. And then I guess, Katie, from your perspective, why is ATO first? Why is it more time consuming?
Well, you're in that respect, you're looking more not just at a payment. You're looking at the entire account relationship. You're looking at the customer. You're looking at verification of customer identifications. You're trying to make sure that the status of the deposit history makes sense. You're trying to develop a profile, and in which that actually really does take more time in order to discern and draw conclusions from the activity in the account and potential bad actors that were participating in that activity. And, that account takeover has nexus to it. It really can start branching off into other bad actors and other connections with different addresses or phone numbers and account names. So in essence, what ends up happening is that an account takeover type of investigation has more to it than just investigation into a set of transactions.
Yeah. And Kyle, are these the kind of the typologies that you're hearing? Are these the top, or are there ones that are missing here that you would have expected to be on top?
No, I think these are. I think the account takeover, I would have expected maybe to even be a little bit higher. And I think one of the things we're seeing, if you look at it from the bad actor side, an account takeover may actually be easier and less steps to conduct than the check fraud. So the account takeover is done primarily online and just gaining access to the account, whereas the check fraud, there's multiple steps that go into it. We talked about kind of the washing of the checks, and you're getting into the physical versus the virtual side of it, right? With the check fraud, a lot of times you're physically going in and performing some activities as part of it. Whereas the account takeover, I'm doing it from wherever I'm sitting, probably in a room of a ton of people who are doing it at the same time. And we have a program that we're operating to try and see where we can gain access and go through it. And I think the other piece too is that you get a lot more access from the account takeover than from the check fraud. If I'm performing check fraud and I have a check for Kyle Daddio account 12345, I now have access to the funds that are in that account. If I take over an account and I collect details from that, I can now get into Kyle Daddio's investment management accounts. Possibly I can get into multiple accounts at that organization and at other banks and financial institutions. And so now I've widened the net of access just from that one account takeover, because I have all of the biographical information, I have all the transaction information. I can see where Kyle has transacted and wired and transferred money between different accounts from that organization and other organizations. So account takeover might be potentially easier to conduct than check fraud and have more value on the back end for the bad actors.
Yeah, I know this.
I think, Ian, just weighing in, I think I wouldn't put a hard line of separation between the two. I mean, you saw in that visual that they're not just selling a check image and an RTDDA information. They're selling all those other pieces of PII as well. So don't draw a really hard line on that. And when I saw this, what I reacted to in terms of time consuming was the remediation of these issues. Both involve you having to re-credential that consumer. But think about your lives with your checking account, your direct deposits, your auto pays, et cetera. Re-credentialing a DDA is time consuming. It takes multiple touch points with a consumer to really get them up and running again. When I think ATO and I think, your kind of your digital identity, the way Kyle was going with that, again, it involves re-credentialing. But just like the attack itself, as Kyle said, the re-credentialing can go faster for the very reasons that it's susceptible to attack, for all the reasons that Kyle said. But kind of my reaction to that.
And good. I did too. One of the things that Don mentioned on the slide prior, where we talked about the three different opportunities, I think that's why the insider threat is being treated a lot more significantly by firms that may not have been doing it before, and we're getting a lot more questions about it because of the access, right? If I'm doing check fraud and I have all that information, I have all that information for Kyle and Kyle's account. If I'm an insider, I have access to everything. And I feel like we're also seeing that there's a lot more hesitation to manage and understand and track employees from a company than there is to manage and track and understand the activity of customers. Because when you're tracking activity of customers, you're tracking it for the stuff that we're talking about on the compliance side and fraud and AML, but you're also tracking it for business and customer experience, right? So you're understanding everything they're doing because there's business opportunities that come out of it as well. Whereas for insiders, like if I'm working at a bank and I'm a bank employee at a branch, I feel like there's more hesitation to monitor and understand what I'm doing in my day-to-day job outside of if I make a mistake or I miss something, there's quality assurance and there's training that comes along with it.
Yeah, it's actually a good point. That was actually very much brought up on the check fraud webinar. We had a representative from one of our credit unions from New Hampshire, and they were saying, that's probably the biggest part. One of their biggest part of exposure is just having the controls to make sure that they can track the people internally, to make sure the people that do have access are not bad actors, right? And so that's kind of a scary thought because everyone thinks about good hiring and your people are your competitive advantage and all that kind of stuff, and then you have to kind of take a little nefarious point of view sometimes.
Well, yeah, there's been a lot of recent articles about institutions and that happening at a very large scale. So yeah, that's definitely happening.
Well, cool. Well, great. So the next one, the third trend is real-time monitoring. So we surveyed like what are the key things that you need as part of any type of fraud tool that you would buy in the next 12 months. And we had a bunch of different in the drop-down options in the drop-down. Real-time monitoring definitely came to the top, and was identified also as like about half have this capability missing in their infrastructure today. I mean, Donna, look, listen, I think you were part of building one of the first real-time rails and payment capabilities in the US with Zelle. And I know that back in 2016, 8 years ago, you had to build a lot of infrastructure around the Zelle mobile app, right? And that was all real time. And so like, why is there still such a gap? I mean, look, you're OG, you built this thing 8 years ago. Why isn't everyone else built it?
I think you got to, fraud is risk management, right? It's about trade-offs. It's about the business case. So for some of the rails, you've got time. even when ACH went to 3 windows a day, you had a wire cutoff window. You had a 24-hour return on checks, right? You had time. So real-time monitoring wasn't really an economic necessity. Where you saw the genesis of this was really in payment cards, credit cards, debit cards, where those transactions, right, can go. And then your economics are around severity and runtime. So as we are shifting to real-time payments, whether it's Zelle, FedNow, RTP, what you're seeing is the need now for your capabilities to keep up with the speed of the transaction. And you've got no recall. You're gone. It's gone, right? The money's out there. It's not coming back. So I think in my experience, even 8 years ago, this was still shocking. This number was probably, quite frankly, even bigger then, to the point, Ian, as you know, we actually had to make it a rule that you could not go live on the Zelle network. You could not be a player in real-time money movement unless you had a real-time fraud engine to back it up. And we had to verify that that was actually the case. And that became a pretty big hurdle for folks. But you almost had to protect the ecosystem of all the banks that were in the network. And you almost had to protect folks and help folks understand the economics of what they were about to get into, the good as well as the bad that was going to come as they moved into real-time payments.
Yeah. Katie, like when you're in your network of organizations, does the 50-50 split of people who can do stuff in real time, does that gel? And if so, why?
Unfortunately, yes, because I
Yeah.
go back to the smaller organization side where the amount of investment that they can put into digital banking environments for security is comes back to trade-offs. Being able to make the money so that you can invest in things later on is kind of the trade-off they have to make. So they look at putting these tools in later, unless they actually have good reason to do it beforehand. If they're smart, they'll do it beforehand. But quite oftentimes they're trying to play catch up. And hopefully they're listening to the risk management professionals that tell them, look, if anything, you really need to create some kind of checks and balances. Any type of real-time monitoring is honestly necessary in this digital age. So it's like policing a small city and only having a flashlight. You really need to be able to put something out there to monitor the streets to help you out.
And Kyle, like, how do you advise your client base of like, you're on the verge of being screwed if you don't have this in place?
Yeah, those are always really fun conversations to have. I feel like there's a lot of times, like very senior executive leadership in the board will treat business operations as opportunities and will treat compliance as reaction. And so it's just kind of always how it's been, because you don't technically make money on paper from compliance. So going in and having that conversation of, and we hear it all the time, right? We're constantly saying the cost of compliance is a lot less than the cost of non-compliance. But what always ends up happening is an outside counsel makes a comment about the regulators coming in, or the regulators are coming in and they're looking at stuff and start asking specific questions. And that's when the gears start turning to, do we need to make an investment in this? And at that point, like Katie and Don have said, it's almost too late. And so getting the opportunity to get in and kind of do the assessments and the analysis and understand where the risks are, and to get, I think one of the things that we're seeing now is that there are people at institutions, especially the larger institutions that have a little bit more leeway and opportunity, and certainly a little bit more funding. They are now looking at, I don't want to be left behind. I may not want to be the first, but I definitely don't want to be the last to get involved in this. And I don't want my name on the headlines. We've got some opportunity here. There's some new technology. Let's at least explore it and see what's going on. And I think there's the clients of ours that have really, really kind of pushed the envelope on that, are at least asking the questions, or looking at what those opportunities might be, what those systems and technologies are that they could leverage to increase this, and then doing a real deep dive into the finances of it. If it costs X amount of money to do it, What is the training? What is the staffing? What is the ongoing validation of that look like? And what's the overall real life cost of doing this for 5+ years? And what's the savings on the back end? And some of the smaller institutions don't necessarily have the experience, the capability, the time and staffing to really do that. And that's what kind of hurts them in getting involved in this market. But I think you're seeing a lot of the larger institutions that have that luxury to be able to spend the money and spend the time and get involved in that.
Yeah, I know. I mean, I work with a lot of organizations that are like tech providers of smaller financial institutions. And I asked them the same question. I'm like, what is the blind spot? And these may be tech providers of regional where they have, 100, 200 credit unions or smaller banks. And it really is this more, I would say, advanced, although, to Donna, it's not, but like, advanced monitoring type capabilities. And they're like, that's a little bit of a blind spot. But also, they don't have a lot of losses yet. Maybe they're not on Zelle. Maybe they're just like their clientele isn't adopting real-time payments in a way that it is at larger financial institutions. So, but that economic model will definitely shift as the rails continue to evolve for sure. All right. So next, this is a little bit of a deeper dive into that answer. One was on the left. It's effectively like who's implemented real-time monitoring. Under 8 billion, over 8 billion, all banks. There's not a huge differentiation, I'd just say, but I just would have thought it would have been more, to be honest with you, based on the prior conversation we just had. I thought it would have been, under would have been a lot more, would have been a lot lower from who's actually implemented. And then on the right, it's the interesting thing about this is when did you implement real-time monitoring, and how do you realize value sits. And so I think what you can see here, one is the organizations that do immediately start. I mean, this is like halfway through the year, and they're already saying 50% are saying they're seeing the value. So they're seeing some value immediately because there was a pain point for sure. But also, those organizations that have leveraged real-time monitoring for the last couple of years, 4 out of 5 definitely see value. So I guess, Kate, I'll go to you maybe first. And like, what are the alternate strategies to using real-time?
Yeah, when it comes to building any type of infrastructure and looking at that supply chain from beginning to end, when the transaction's initiated all the way to the end when it's finalized, there's different pinpoints that you can build in controls and resistance. So you can either do it from the preventative side and a combination with the detective side. So with this, what I often see is that folks will at least put some type of monitoring in on the detective side, and then look at it as a future investment and enhancement to be able to put it in as the preventative. Because if you want to kind of obstruct consumer value, then you'll put resistance in before they've been able to finish something. That creates good and bad reputation risk. But so quite often the real-time monitoring happens on the detective side. And so this absolutely makes sense. And like I was saying before, you really cannot watch thousands and thousands of transactions on a daily basis, millions of transactions on a daily basis without something to help you. You really need to be able to do it. I've talked to people that do it by hand, and I weep for them when they tell me that.
Hey, Donna, I remember you used to always say, like, back in the day, you'd be like, hey, if you want $2 of bottom line, give me $1 of expense, because you can protect against fraud hitting the bottom line. I don't know, maybe I'm making that up, but I feel like I used to say that. But what was your approach if you were sitting in the 41 or 38% where you don't have it? Like, what would your approach be talking to an executive trying to get more budget in year where budgets are already spent?
You've got to know the P&L that you're impacting, both from a customer perspective. So is it retention? Is it friction? Is there revenue opportunity there? So you have to know the P&L. From a good perspective, you've got to know the P&L from an operating perspective, whether they're being allocated expenses, they're taking the losses directly, and you've got to know your losses. So what is it about your runtime? What is it about your severity? What is it about accuracy? And if you start to gradient and move those needles, that all ultimately goes into your business case to say, here is the ROI, and here is also, by the way, how quickly I can begin to see that benefit on these different kind of three legs of the spectrum. You start to put all that together. I mean, there was nothing better for us, even in year, because here's the good news. Fraud typically has a write-off of 90 days, within 90 days of the point of identification. So you're not looking at a 180-day plus credit cycle, right? So you actually, good news, you have a greater opportunity to have an immediate in-year impact. The finance team now becomes your best friend. Where else in the bank are they going to go and see an impact within 90 days on an investment they make? And if we were really firing on all cylinders, now this came more around the traditional budget cycle. But again, we've all been asked, we will all continue to be asked, like, hey, we're off on expenses, we're off on whatever, what can you do? Well, then you have all this stuff in your back pocket, like, hey, we're ready. Like, you want to invest here, here, or here. So, but I think most importantly, know the three elements and know the impacts you're going to see. Don't just think about this as losses. You're grossly underestimating the ROI. You're grossly underestimating the sponsorship around your organization that you can get to evolve your capabilities.
Classic salesperson, Donna Turner. That's great.
Those are words I've never heard.
Well, you can set. It sounds like you can sell a CFO more expense in the middle of a budget year. So, like, I mean, that sounds like pretty good sales to me. All right, Kyle, I'll get to you in 1 second. So we have a couple of bonus topics because we're kind of coming up on time. So I'm going to try to get to the last few slides. So one was around efficiency and self-sufficiency. So one was we had about half of the banks, 46%, can implement a new rule. So these are like fraud rules. If you're seeing a certain vector that you haven't seen before, you got to implement a rule within 2 weeks without relying on outside sources. And there's ways to do this. One is you rely on your internal engineering, or you deploy rules yourself. Now, I work for a rules engine company, so obviously like a little bit there, but it was really interesting thing was that of the banks, and this was a field that people could respond to, like a drop down of how long it takes to actually get the rules deployed. If you're relying on engineering, 50% of the people said it takes up to 8 weeks. And if you can deploy yourself, or if you have the resources in, it takes 5 business days or less. So I guess, Kyle, is the group on the left screwed?
Well, not necessarily. I think this is a really interesting slide, and I think there's different ways to go about it. One thing where we see where they're deploying it themselves, there's the speed to it, but then the second piece to it is the expertise, the accuracy. Do they have the requisite people to not only do it, but to continue to manage and maintain it? Do they have the ability to validate and test on an ongoing basis? Like, do they have, similar to some of the other issues, right? If it's not necessarily just deploy a rule and then get back to your daily job and leave it alone. Conversely, the 8 weeks on the engineering side, the one issue you run into there, obviously, aside from timing, is, are the engineers experts at engineering, or are they also experts at fraud, financial crimes, AML, things of that nature, right? Because we've worked with institutions where they have incredible engineering teams internally. And they say, we have some of the best engineers in the world from some of the best universities. They'll make rules for us. But if they don't understand the outcome, the output, the use case of what that rule is trying to create and it's going to be done with it, and they're just looking at it as we're deploying a rule, that becomes an issue when you then need to go to make changes to it when you're testing it and things like that. So I think there's interesting negatives to both sides of it. I think if you can deploy yourself and you have the capability to continue to test it and run with it and manage it appropriately, that's a huge benefit. Another downside too is when you come in for audits and exams from regulators, right? If you're not getting it third-party validated or tested, if you haven't at least had a third party assess it at some point, even though you're creating and deploying your own rules, there's going to be a lot more scrutiny as opposed to having that third party at least take a look at and assess it, if not even deploy it on your behalf.
Yeah. Katie, are you feeling the same?
I look at these numbers and I think I kind of put my model risk manager hat on, and I think about the two different scenarios. Either, on the one side where they have capability to make some tweaks on some rules here and there based on observations that they're doing maybe in more of a coordinated fashion, or are they trying to utilize from an engineering side a little bit more of a holistic approach where they're working with the provider to do a more in-depth analysis and maybe tapping into consortium data, things like that, that would really benefit from having a longer stay so that they can dig into the data and make changes to more than just a few tweaked rules, but they actually are doing a full assessment of their whole rule bank.
Yeah. And Donna,
I'd just say separate. Yeah, sorry, guys. Separate, Katie, your models and your build. They're not screwed, but let's just say they're grossly sub-optimized. 5 business days is ridiculous. Like, you need to be able to put a rule in within hours, if not minutes. And I'm not negating what Kyle and Katie have said around checks and balances. I think you need a discipline, that you understand the urgency of the rule. So we created strata that said, hey, you've got X number of hours, and it wasn't a lot of them, to review this. And your audience is your folks in your contact center, your folks in your product and marketing line, right? If you're gonna take a high false positive because of the severity or the aggressiveness of the attack, well, your contact center call volume is going to go up. You need to let them know that. If you're going to implement a rule that is maybe completely contradictory to the marketing that's going on right now, you might want to make sure that you're aligned with your product and marketing team. So it behooves a lot of broad communication where everybody's aligned on the urgency that comes within hours or minutes of making a necessary change to be back that attack rate, to be back the severity and the runtime of what you're facing. Yes, you need discipline around make or checker. Yes, you need to look for technology or have discipline that said, I wrote a rule, but maybe it puts me at risk of a reg violation. Again, this is also, by the way, why you have your risk partners on those kind of APBs that you put out on a rule change. But for the love of God, do not think about this, that doing something in days and weeks is okay. You are just elongating the attack that you are going to get. You are enabling their success, therefore driving your attack rate up. You've got to get this down to hours. Not that I'm passionate about this one.
Slight non sequitur. I was at a race with my daughter back in 2016 when we launched the Zelle mobile app, and there may have been a certain vector that happened on a Saturday morning, and I call up Donna, and she was smooth as silk. She's like, "No, this is within what we thought. These are what we're doing." It was like minutes. I was like, man, I was freaking out. My head was on fire, but Donna's wasn't. All right, I got one more slide.
Be the duck. Be the duck.
All right, I got one more slide, and I'm going to wrap it up. Okay, so this was actually an interesting thing. It's a little funny. So we asked folks around working fraud alerts. So rule fires, creates an alert. How long does it take? And we asked analysts and we asked executives, and the analysts were like, it can take, probably over 10 minutes, mostly, between 10 and above 30 minutes. The executive's like, no, it takes less than 10 minutes. So are the analysts, are they lying, or do the executive think that they're not working hard enough? Donna, go.
Do they, I just wonder if this was stratified by institution size, thinking, is there that correlation between real-time monitoring and not? And then you get into context, right? Spent per alert. Am I not thinking about the plethora of them that I just approved and went on to the next one? Am I only thinking about the ones where I have to go maybe deeper, maybe start to try and think about some spider webbing out, et cetera? So when I get a hit, how long am I spending? So it's a little bit of vernacular and context. I would tell you that most of the alerts when you're talking payment card transactions, check transactions, gosh, I can't think of a single one where the productivity expectation was probably less than 1 minute per alert, let alone less than 10 minutes. But again, maybe as an analyst, I'm thinking when I get a hit, when I actually have to engage with a consumer who's like, no, that is not me, and I start those remediation efforts. So that's my reaction to this.
Gotcha. Katie, any reaction to this one?
I 100% agree. I think it kind of, to this slide along with the one with the last one, I think it really just has to do with the way things are phrased for the participants, and this and that frame of mind where they're kind of offering their thoughts and their insights. Because to that point, if you have a real-time alert monitoring software and they're looking at the RDC checks that are coming through, it should not take them very, very long. But if they're doing an actual investigation, it will feel like a while when they're trying to do something.
Yeah. Kyle, any type of advice that you give your clients when you think about like efficiency of working alerts?
For efficiency of working alerts, a lot of it comes down to the training and the QA feedback. I mean, I think that there's a lot that firms are starting to do when they bring on new hires. There's a lot of training that goes into when new technologies are put into place. And was just on a call this morning with a client that had implemented a new transaction monitoring system and wasn't even aware of all the capabilities that it had. And it's eventually kind of cutting that alert and case management and case investigation work time down significantly. And so I think understanding what they can leverage where is really going to be a big benefit for a lot of the analysts. And then, making sure the executives fully understand what they have, right? What are the capabilities that the systems have? How is the training done? How is the staffing done? We do a lot of work around staffing analysis and communicating it and presenting it to boards and making sure that they understand kind of what their team is working on and where there's gaps in that. But I think there's a lot of context behind these numbers to really understand exactly what they mean. I think Don and Katie are spot on with that. But I think the use of the technology and implementing what's out there is a big deal for a lot of these firms.
Well, that's great. And this has been like a chock full hour. So I really appreciate I'm actually going to bounce the last couple of slides because I want to make sure, like, one, if you want to learn more about Unit 21, obligatory commercial, we have transaction monitoring, maybe definitely real-time async case management. We have a consortium ourselves. Check out unit21.ai. But also, we'll be releasing this at Money 2020 in a few weeks, the broader findings. So again, this was very specific to banks, but we have a cut on credit unions, fintechs and such. So I really appreciate Katie, Kyle, Donna, you guys spending some time with me today, and American Bankers, the ABA, helping us out with a sponsorship here. And hopefully I see anybody out there at Money 2020. And again, thank you all. It's been I think I had to like slam through the last 30 seconds because we had such a good discussion. So appreciate you all. And thanks for the impromptu movie TV show question, engaging in that. All right, everyone have a great day. Appreciate you all. Talk soon.
Bye. Thank you.